If L1 Blockspace is a commodity, then I don't care how big the network is, the valuation trends towards zero.
Blockspace is not a commodity. Saying Blockspace is a commodity is like saying corporations are a commodity because anyone can form a corporation.
Valuations and value accrual, I feel like this is the last boss that we need until crypto becomes an asset class at par with like all the other established ones.
Right now in crypto, we do not have a shared model. Networks are more complex than companies.
The early work in ascribing value to stocks and things like commodities sort of settled on two laws of physics of valuation, which is either cash flow or scarcity. It's too early to expect to value these things on revenue.
There will be a few winners of the L1s, and those winners will distinguish themselves by
Hello, Breakdown listener. We're still getting ready to roll out a new season, which starts next week. So in the meantime, we have a crossover edition with the new Inflection Point podcast, recorded live at DAS New York last week, all about crypto's forever-long quest for better valuation metrics. See you soon.
This episode is brought to you by Nexo. Step into a new era of digital wealth. Earn interest on your digital assets, borrow against them without selling, and trade all in one platform. Get started at nexo.com/breakdown. Nothing said on The Breakdown is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and any views expressed by anyone on the show are opinions, not financial advice. Hosts and guests may hold positions in the company's funds or projects discussed.
Hello, Das. Thank you for being here. This is day 3 final of the conference, and I'm excited to introduce you all to Inflection Point, which is a new podcast that we launched this month, 3 weeks ago. This is our first live podcast. So actually, it's the first time all three of us have met each other in person, so it's exciting for us as well. Before we kick off, let's just start with some quick intros. So David, you.
Yeah, hello everyone. Very excited to be here. My name is David Lawan. I'm head of research at Anchorage Digital. Before working at Anchorage, I had positions in other crypto shops, both on the sell side and on the buy side. I had the pleasure of working with Matt Hogan at Bitwise, and before that, I used to work in TradFi doing sell side equity research.
Amazing. Matt Hogan, Chief Investment Officer at Bitwise. I've been there for 8 years, from $1 to about $15 billion in assets. Before Bitwise, I spent more than a decade in the ETF industry as the CEO of ETF.com, helping build the first data and analytics effort in that space.
Good.
Hey everyone, Michael Marcantonio. I'm the head of DeFi at Galaxy Digital. We focus on all things trading and market making on decentralized networks. Before being the head of DeFi at Galaxy, I spent most of my career as a corporate lawyer, focused on M&A.
Okay, awesome. And I'm Mark Arjun. I'm Senior Research Analyst at Blockworks, but now my proud title is host of this Inflection Point podcast, institutional focused podcast. But today we're going to talk about L1 valuations. It's a little bit more crypto native than our usual topics. It's a difficult topic, but I wanted to share something very exciting with the audience. None of this information discussed constitutes investment advice or an offer or recommendation or solicitation by Blockworks, Galaxy, Bitwise, Anchorage, or any of their affiliates to buy or sell any securities. Okay, that out of the way, let's kick it off. Matt, backstage we were talking, and this is your third city in 3 days. You've been traveling along a while, so yeah, any insights?
Yeah, I was in St. Louis 2 days ago giving a speech to a CFA society and visiting a major national account firm. And then in Phoenix yesterday at the Barron's Top Advisor Summit. I tweeted about it a little bit, and someone responded that there is not a crypto winner in institutional crypto. There's a crypto winner in vaporware and a crypto bull market in institutional crypto. I think that is true. I'll give you a specific piece on the Barron's conference. I've been going there for 4 years. It's the largest RIA gathering of the top RIAs. 4 years ago, I was in a breakout session pre-conference, and this year I was the keynote lunch speaker. And I'm not saying that like for me, I'm just saying that for crypto, it's moved from off stage to literally the keynote of the whole event, possibly. And I think that's a sign of how far we've come and how much the interest is.
Okay, awesome. I mean, you mentioned something about the vaporware. I think that's kind of tying into, this is an institutional conference podcast. blockchain, not Bitcoin kind of narrative that we saw in 2022 and even before that. So let's just get into the valuations, right? Like, and specifically like L1s. I'm gonna give my take first, and then you all please disagree with me where you think I go wrong. So coming from a TradFi background, this is how I kind of view it. I like the DCF model to begin with. I like the fact that these chains have fees. I see them as GMV, and then certain chains have burned. Some of the tokens that are used to process fees on a network are burnt. So I see that as the chain's take rate. And that's basically the revenue. And it just happens that the blockchain uses all of its revenue for a share buyback. At Blockworks, we promote something called REV, Real Economic Value, and it's a proxy for the demand of transactions on the network. And so even if you don't like the DCF model, then if the burn outweighs the token emission, then you have a deflationary asset. I think that may be also important if you are valuing it as a commodity or even as a store of value. And I know we don't like to use that terminology often here. People disagree with me all the time. What do you guys think?
Yeah, I disagree. So before we look at valuing blockchains, we should first think about how other instruments have been valued in the past and the history of them. So if you look at the history of how stocks were valued, before 1934, so we could say between 1600 with the East India Company and 1920s, there was no formal methodology for valuing stocks. There was no agreement among stock purchasers about how a stock should be valued. And then in 1934, two guys, Graham and Bell, wrote a seminal paper called Security Analysis. And they came up with a formal methodology for how to value a stock. And that methodology looked at cash flows, it looked at financial statements, it looked at book value and dividends. And it's not to say that they got it 100% right. They didn't. But what they did was they built a methodology, but that methodology was more important than just figuring out how to value the stock. It was presenting the conditions on which you could ascribe value to something. And once everyone adopted it, two important things happened. First, the securities laws reflected that methodology. It is no surprise that the Securities Act and the Securities Exchange Act really focus on disclosure, financial statements, right? This is effectively channeling what Bell and Graham put out. So then we had in 1938, we had the dividend discount model, and that was proffered by a guy named Bell Williams. And what he did was he said, the net present value of the dividends of a company, that is how you value a company. Both of those methods had a very novel interpretation. It was that a stock has intrinsic value apart from the market value. Then, of course, we had the discounted cash flow model, which basically just generalizes the discounted dividend model, and it looks at the future cash flows of a company, and the CAPM model. But all of these models were critical for institutions to center around how to value these things. Right now in crypto, we do not have a shared model. And the reason is actually pretty obvious. Networks, let's talk about L1s. Networks are more complex than companies. Companies are complex, right? I'm not going to tell you it's easy to value a company. It's not. But networks are a degree of complexity above companies. And so what we've seen is a bunch of attempts to value a network. And those networks, those valuation methodologies they lack two critical features. One, they're not complete. They don't cover the entire range of the things that we want out of a valuation methodology. And two, no one agrees with what they are. And until we get both of those things, we're not going to be able to really ascribe value in a shared way, and you're not going to see as much growth in tokens. But that is coming, and so Blockworks does a great great bit here because you're at least advocating for a model, right? That's important.
Step into a new era of digital wealth with Nexo, the premier digital assets wealth platform. Earn interest on your digital assets, borrow against them without selling, trade a wide range of cryptocurrencies, all in one place. Nexo is now available again in the US with an evolved product suite tailored to today's market. For a limited time, new US clients can unlock 30 days of exclusive Wealth Club Premier benefits, including enhanced interest rates, reduced borrowing costs, and up to 0.5% crypto cashback on trades. Get started today at nexo.com/breakdown. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
I'm going to split the difference and say you're both half right and half wrong. So I think, Mike, to your point, I agree that we don't yet have the model. I agree that will be hugely valuable. I think the early work in ascribing value to stocks and things like commodities sort of settled on two laws of physics of valuation, which is either cash flow or scarcity, right? And I wonder if the model we're constructing has to build on those two laws of physics. Those are like, like the gravity of financial assets. And I agree we don't yet have the right mix. And you can see people debating which of those two laws of physics apply to this new thing. And the answer is probably a combination of both. I think the tweak I would put on what you said is that I think the issue with revenue right now is that it's too early to expect to value these things on revenue. By which I mean, imagine you were the CEO of Ethereum and you were in charge of setting prices. Would you set prices today to maximize today's revenue? Or would you set prices today to maximize market share on the view that you can optimize revenue in the future once you're embedded? You would do the latter. If you did the former, you'd be insane, right? No one wants an average ETH transaction today to be $30. It would completely lose the market to everyone else. And so focusing exclusively on revenue today is like focusing on revenue for a seed stage startup. So I think it may be part of sort of the end boss solution of how to value these things, along with other aspects like this commodity aspect. But I think we don't actually want chains maximizing for revenue today because they should be maximizing for market share and embeddedness.
The cool thing about valuations is that if you ask 4 people, you're probably going to have 4 different answers. And that's what we might get here. I think it shows how early we are in this topic. Just before we get there, there's one thing I want to say. This is probably, and we're talking a little bit about this in the backstage, this is probably the last foundational topic that we need to solve for crypto as an asset class. And here I'm talking about crypto beyond Bitcoin and beyond the hundreds of billion-dollar assets like Ethereum. I think this is what we need for us to see crypto as a much broader asset class. We solved blockchain scalability. We survived a very hostile regulatory environment. We found a multitude of use cases with product market fit. I think there's still some things to figure out on those fields. In the last episode, we talked about the SEC guidance and that for some assets, I feel like there's a few unanswered questions there. But now valuations and value accrual, I feel like this is the last boss that we need until crypto becomes an asset class at par with like all the other established ones. And I agree with a lot of what you said. But the one thing I would say, and this comes from my background as an equity research analyst, I've been doing DCFs for a long time, huge fan of all the current methodologies. But if you ask to a lot of the equity investors, the DCF is a tool they use, but usually it's not the main tool. For a lot of folks, it's actually not even a tool. If George Soros, I'm a huge fan of George Soros as the investor, maybe not the other stuff, but George Soros says he never used it, and he is probably the best performing investor of all time. He just has a different background and a different way of thinking of things. GCFs are more art than science, especially for early stage assets, and I think that's getting to your point a little bit, Matt. Like a venture capitalist can probably do a DCF of an early stage startup. But do you think anyone invested in Google's Series A because they did a DCF of Google or Amazon or Uber? No. you are looking at the team, you're still looking at the market, you're still looking at some disruptive technology that you think will overtake some sort of mainstream investment or mainstream sleeve of the economy. So I think DCFs are very important, but I would say they might not be, and for some companies, maybe they're already in the stage where you can just justify your valuation from the DCF side of things. Maybe some of the more advanced crypto dApps are already here, but I don't think it can be the only tool. Still, it's a very important one because having revenue shows that the market is willing to pay for whatever service you want to provide. So I want to see DCFs as a tool, and I think that the commodity environment actually will play a role. Crypto is a blend between commodity and like a cash flow generating a business, and we have to understand for each asset how big is the commodity side, how big is the cash flow side. Even in L1, right? Ethereum is commodity based, I would say. Hyperliquid, which is an L1, is probably very heavy cash flow based. So it's going to vary asset by asset.
Yeah, I actually think that's a really good point. We talk about it as an asset class. It may not be an asset class in the sense that you can apply the same valuation metric to each different piece. You may need very different valuation metrics for different parts of the stack, from dApps all the way up to Bitcoin.
Yeah, I mean, valuing networks is more complex. I agree. DCF is not particularly the most appropriate model for valuing a network. It's a part of the equation, but it's not the full thing. I would think, and just spitballing here, the core intuition we are trying to solve for a value on a network is what? I think it is network effects and network activity. Now, DCF might matter as a proxy for network activity. If it has revenues, it has activity, right? But it's not the only thing that matters. There's a bunch of other things that will matter. So there was a debate last year between Solana and Ethereum. Ethereum said the most important thing is TVL. Solana said the most important thing is revenue. I think they're both right. I'm not just saying that to split the baby. I think they're both right. Revenue matters because it is a proxy for activity. TVL matters because it's a proxy for security. And if you care about the token valuation, you have to care about how valuable the network is. And that can only be understood in terms of, well, the primary way it could be understood is how valuable are the assets that sit on that network, right? Just as a thought experiment here, right now, Solana is about a $50 billion network by market cap. So you could take over the network with $25 billion. I'm sure there's people here that have that much money, and we could, you guys could take over Solana theoretically. You would never put more than $25 to $50 billion of value on a network that could be taken over for half that, right? And so if you think about it, the more valuable assets that sit on a network, almost inherently, the higher the price for the native asset must be, because the higher that price offers greater security properties. So it's a complex topic, but I think the best proxy is how to look at networks as economies. And these are their own economies. And they're very complex. I think we have to take a page out of macro, honestly, and how macroeconomists look at value in economies.
Let's take a moment to talk about Nexo. Nexo delivers a premier digital assets wealth platform designed to help clients build, manage, and preserve their wealth, earn interest on your digital assets, access crypto-backed credit without selling your holdings, trade with advanced tools, all supported by 24/7 client care. Now back in the US, Nexo offers new clients 30 days of exclusive Wealth Club Premier access. That means enhanced interest rates, reduced borrowing costs, and up to 0.5% crypto cashback on trades. Benefits typically reserved for Wealth Club members and private clients. Nexo is also expanding its global presence, becoming the official crypto partner of Tennis Australia, the organisation behind the Australian Open, and the digital asset partner of the Audi Revolut Formula One team. If you're ready to approach digital assets with a more structured wealth strategy, visit nexo.com/breakdown to get started. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
Hey all, Blockworks co-founder Michael Ippolito here. Quick break to talk about something we've just launched, Blockworks Investor Relations. As the market shifts toward institutional capital, investors want more transparency, more standardization, and a higher level of professionalism. But The traditional IR model is slow, manual, and not built for how crypto works. If you're building on chain, your data is already live, your business is already transparent. The challenge is turning that into a clear, credible story for investors. That's exactly what we're solving with Blockworks IR. It's a single platform that brings together real-time analytics, branded investor portals, and hands-on advisory support so you can communicate what matters. If you're an on-chain business looking to level up your investor strategy, check out Blockworks Investor Relations at blockworks.com/investor-relations. All right, back to the episode.
I think you can't really just take over a network with 25 billion. It's not like you can buy it outright. It will push up the price. But I do agree with the networks, because like network effects, you can use something like Metcalfe's law to judge something, and it grows with the square root of the number of users and connectedness. And I think it's more of a correlation. The more users who are on the network, the more they trust the network, the more they'll put value on the network. So I think it's more of that kind of causality relationship. And the other thing we talked about, like, yeah, okay, maybe revenue can be seen as a way of network effects. But one of the reasons, and if you want to eliminate monetary premium from the conversation, one of the reasons why Ethereum could be seen as more valuable is because of the diversification of the revenue streams and the sustainability of those revenue streams. For instance, a software as a SaaS company, they have a recurring revenue model, so they're gonna be assigned a higher multiple premium than a bricks and mortar shop. On revenue, the revenue streams come from DeFi, from NFTs, from stablecoins, from tokenization. It's very diverse. Whereas on Solana, it's a little bit more on the trading side and a little bit on the speculative side, where it might be a little bit more ephemeral. So I think maybe the market gives a higher multiple premium to Ethereum because of that more diversified and sustainable revenue and fees coming from that.
I think I think the Metcalfe law thing, just to sit on that for a moment, is only a useful metric as a precursor to revenue. If there is no revenue at the end of that rainbow, it's a useless metric. The internet is the largest network in the world. The valuation is zero because it's not a precursor to revenue. I think that's a tool that people have used to value networks before we get to revenue. So I wouldn't use that as the end boss. I think the reason it's useful, or rather it is only useful, is what you're describing is true, which is that ultimately L1 block space is not a commodity. If L1 block space is a commodity, then I don't care how big the network is, the valuation trends towards zero. If L1 block space is differentiated and more like nation state GDPs and more valued on security, brand, moat, etc., then network effect is a useful proxy for how we eventually end up at revenue. So I think that's probably like a key question. And I actually agree with the point you were pointing towards, Mark, which is it is differentiated. And therefore, I do not think it is a pure commodity. And that is one of the reasons I'm optimistic long-term on L1 valuations.
Agree with that. And I think that gets to a very important point that I think speaks about the stage where you are in the industry right now. Blockworks is doing God's work, showing like all sorts of fundamental metrics. You can see their research dashboards. It's really amazing. But if you use, again, and let's discuss like the quote unquote revenue metrics and DCF metrics. Let's use multiples as a simplification of a DCF, right? You're not going to do a 10-year DCF, discount the cash flows. You're usually just going to do a revenue multiple or a net income or kind of profit multiple, something like that. Like in traditional markets, the first thing about multiples is that they're forward-looking. So like no one is looking at, let's say, Apple's or Microsoft's price to earnings ratio of the last 12 months. Everybody's looking at in the next 12 months or what 2027 is going to look like, or 2028 if you want to push forward. In crypto, I feel like we are still like annualizing the current revenue rate, and that's the multiple we talk about. Also, like in TradFi, if you go to a Bloomberg terminal, you're going to find 25 analysts who cover Apple or any big stock for a very long time. And they're going to have estimates for every single important financial metric for the next 3 to 5 years. And you can just see pretty much where valuations are. And I think we still need to develop that. And I think Blockworks is being a very big pioneer in that space. But I think we still need to develop this quote unquote sell side future estimate industry. It's hard to do because these things are still very early, but I'm pretty confident that in a few, I don't know, maybe year or two, we're going to start to be able to start thinking about estimates, and you're going to see where the market is. And I think, let's say, my opinion is higher or lower than that, and that will help me to underwrite an investment decision. So there's still certain like things that need to come over time as the industry evolves that allow us to look forward, which I think is what Matt was getting to, and then you can use the Metcalfe reasoning to project the future with a little bit more certainty.
Yeah, I strongly agree with that. I think it's a really strong point, and I would note one of the reasons people are thinking these valuations are really high on these metrics is that they're all backward looking. If you did that on equities, you'd be like have the same sort of view. Everything would be overvalued. So I think that's an important point.
So, you know,
I was just going to say, I think it's worth noting that when we're talking about valuations and the uncertainty there, I'm talking about, and I think we're all talking about L1 valuations. I think for apps, decentralized apps, let's say Uniswap or Morpho, a more standard DCF analysis actually makes a lot of sense because they are more like companies. Now, they have network properties, of course, but they're more like companies. I also agree with you, Matt, about how Blockspace is not a commodity. Saying Blockspace is a commodity is like saying corporations are a commodity because anyone can form a corporation. There's just infinite supply of corporate charters that you can get out of Delaware or any other state. What matters is whether that corporation has other properties that people want to invest in. And so I agree completely. There will be a few winners of the L1s. I don't think there will be one. I don't think there will be 100. There will be a few winners, and those winners will distinguish themselves by generating the most activity and being useful to the global economy.
So I mean, I agree with that. I love the revenue generating apps from a sell side equity research background. I can just do a DCF, slap on a price to sales, price to earnings ratio. So I mean, that's what I love writing about. But I wanted to ask you all, we're talking about this very abstract valuation stuff. Like when it comes to maybe your PA or maybe for clients, like what are you actually looking at? Like maybe it's one metric, maybe it's a combination of some. Like for me, for instance, something I track is a historical price to DEX volume, because DEX volumes have been highly correlated with price, and it shows you activity, it shows you network effects. It kind of is a proxy that bundles a lot into one. So maybe I'd make a mistake with the 30-day annualized. I know I don't really have forward-looking estimates, but like I track price to DEX volumes on the different L1s to kind of give me a gauge of where we are in the cycle and which is over or undervalued. What are you all looking at?
And don't get me wrong, I also look at the current revenue annualized. I'm just saying how I would like the future to be. I don't think we're there yet. But yeah, I mean, I think for me, and then again, I think there is this distinction between commodity crypto assets and cash flow generating crypto assets. And some L1 assets can be kind of both, right? Again, Hype is L1 and they're very cash flow heavy. Ethereum is an L1 and they're very, I would say, commodity kind of valuation heavy. So that's the first distinction. But all network utilization metrics, I think, are very helpful. And I think this one you just mentioned is actually super interesting, Mark. I honestly haven't thought about it. The other thing that for me is very helpful is because we are now at a stage where you usually have a couple of competitors either within the same chain or cross chain. So you can probably compare assets as well. So relative valuations, I feel like, are relatively interesting, not to necessarily do long short positions. These are, I think, still hard to do in crypto, but at least to give you a sense of who is cheap or expensive on a relative basis. So I think for me, that's kind of interesting. That's where Ethereum looks hard, because like if you compare, I fully agree with you. Ethereum is more diversified. Ethereum has a very strong foothold, maybe in the more institutional tokenization side. But Ethereum's network value is, I don't even know the number right now by head, but it's what, 4 times higher than Solana's,
Yeah.
right? So that's where things start to get complicated. For me, when you start to compare them with one another.
Yeah, I agree with all of that. I think often from a 30,000-foot view and sort of early stage VC model, when I think about most of, no, but not all of these assets, which means that I value growth more than current revenue, and I value market share in important niches as an extraordinary thing because I'm betting on that niche growing. And revenue, network activity, transaction activity, wallets, et cetera, all of that contribute to the growth question. So those are all really important features. But I would rather have something growing fast with small revenue than high revenue and growing slowly, because I'm optimistic on the scale of the opportunity. And similarly, I would rather have something with a large and growing lead from a market share perspective in an area that I think will expand, rather than a shrinking market cap or a small piece of a market that I think will grow. Just because I think most of these categories have, 100x growth, right? Tokenization could 1,000x in terms of assets. So you really just want to own that space in a fast-growing area.
Yeah, I'm often disappointed in relative value because it doesn't make a lot of sense how, well, there's 2 things. One, if you're looking just at revenues, then Hyperliquid and Solana should be valued roughly the same as Ethereum, right? Or it should be valued closer to Ethereum. And then you have to ask yourself, is Solana undervalued or is Ethereum overvalued? And that is a tough one. The other thing is on dApps even, like when I'm looking at Uniswap's volume and it has its best day ever or best month ever in volume and the price barely moves, you start to say, am I right about the price or is the market right, right? This is what leads me back to a shared methodology. It's not to say that everyone uses that methodology, but at least everyone agrees that that's the foundation of some basis. Obviously, if everyone used the same methodology to value stocks, then no one would make any money because there's no edge in using the public methodology. But just having a shared sort of vocabulary about what a value system looks like for a L1 blockchain, I think it's incredibly important, and we need to get there. I don't know if it's going to come from Blockworks, or I don't know if it's going to come from academics. Historically, it's come from academics, right? And I think institutions need 2 things to really enter crypto fully. The first, they've gotten, I think now, or are getting, which is regulatory permission. But the second is intellectual permission. And that comes from the academics, that comes from universities, that comes from the economists who say these things have value and here's why.
I would just add in, because Mark won't, that the closest we have is the work that Blockworks is doing on investor relations and on the revenue stuff, at least from my perspective.
Especially what Mark's doing.
I love my panelists. So I wanted to do, okay, I'm doing some market research here. This is the morning. So if you think that L1 assets with small inflation is okay, then stay silent and make me look like a fool. If you think that you would like to invest in an asset that is deflationary and supply is decreasing over time, let me get a round of applause. Okay. That's pretty split there. Okay, love it. I appreciate the camaraderie.
Well, what's your position?
Deflationary assets.
Deflationary.
Yeah, I would love to invest in something that is decreasing supply over time. I don't think the TradFi markets have anything like it. But
sorry, one quick point. I got.
We'll have to do another episode.
There you go.
We'll
But if I am correct that a blockchain should be modeled more like an economy than a business, then you would have to say that you favor economies that are in deflationary right? In a deflationary spiral.
I think that's trying to put it in a box. It can be both, Mike. It can be both.
Well, it had to be in a box because we've got 14 seconds.
Well,
Right.
y'all will have to tune in for the next episode of Inflection Point. Thank you very much for your time, and thank you.
Thanks,
guys.
everybody.
Thank you.